Hi, hello, how are you guys? Hope you all are doing really great. Let's start with the next chapter in the supervision series, that is chapter 4, Dissolution of a Partnership Firm. Before starting the chapter, let's just remind ourselves of the 3 points that we have agreed upon together. The first one is this is a revision lecture and not a substitute for your full syllabus course. And the assumption is you've already done this chapter at least once in the whole year. The second point is you have your notebook and a pen with you to scribble down whatever I am writing. Right, and the third one is you're sitting and watching the lecture and you're not on your bed and listening to it as your bedtime story. So this is chapter 4 of your textbook 1. This is the last chapter in your textbook 1 and even your last chapter in partnership accounting. I'm here with the mind map. Again, the basic structure of mind map, which you can pause and write it down, and we'll together build a beautiful chart for revision. So the chapter is divided into 5 points again. The first one is key concepts. So in the key concepts, we have 2 different concepts. The first one is dissolution of partnership, and the second one is dissolution of firm. What is the difference? Does it sound very similar? But it is quite different, my dear. Dissolution of partnership is when there is a change in a relationship between partners. Okay. And the firm may continue the business. So, have you heard of this before? Did we? Do you remember anything similar? No? Yes? Yes. We have to remember something similar. This is nothing but reconstitution of a firm. So when there is admission, retirement, or death of a partnership of a partner in a partnership firm, that is called reconstitution of a firm. And that is also called dissolution of partnership. Now moving on to the next point, that is dissolution of firm. This happens when relationship among all the partners comes to an end. Change in relationship between partners is like what? Should I give you an example? So it's like you were friends earlier, now you are more than friends. The relationship has changed. This is change in relationship between partners. And now you were more than friends earlier, now you are strangers, complete strangers. This is end of relationship between all the partners. I'm talking about partners in the partnership firm. Don't keep assuming things, right? Concentrate on your boards that are even in less than a month. And here the business completely comes to an end. That is, business completely closes. Okay, cool. Let's move ahead. In this, we have another thing that has to be studied, that is section 39. Of what? Of the Partnership Act. Partnership Act 1932. We have read section 4 of Partnership Act 1932 in chapter 1 for the definition of partnership firm, and this is section 39 of Partnership Act 1932, which is for dissolution of partnership firm, that is dissolution of partnership between all the partners of a firm is called dissolution of the firm. What? See here. Concentrate on the words. This says dissolution of partnership. Dissolution of partnership is the first concept. When dissolution of partnership between all the partners occur, then dissolution of firm happens. Right? Now, so this is reconstitution and this is dissolution. Now, what are the differences between? Let's make a small table over here for the differences between reconstitution and dissolution. Okay, this is here business continues. Here business comes to an end and business ends. Here old firm survives. So these are the key words that you have to remember while writing. You have to write it in English. Now you know English. We are studying English from like childhood. So we can make good sentences, right? Here, no realization. So this is point 1. This is point 2. Here, no realization account is prepared. So that means realization account is not prepared. And here, realization account is compulsory. Okay. Okay. Let's move ahead. Modes of dissolution. How do we dissolve the firm? Now, here we have to remember dissolution. Here we are discussing about only dissolution of firm. Okay? Okay. Oh. So, modes of dissolution, it can be by agreement. So, agreement with mutual consent of all partners or as per the partnership deed. The second one is compulsory dissolution. When does compulsory dissolution happen? Compulsory dissolution happen when all the partners become insolvent. Okay, all the partners become insolvent. All the partners are insolvent except one of the partners. So only one, if only one partner is insolvent, then also firm cannot continue. Or all or except one of them is insolvent. Then the business becomes illegal or unlawful. Did we study in the first chapter that the partnership can be created only for legal and lawful businesses? And there is a war situation. And your partner, one of the partners, is from alien enemy, or you deal with the alien enemy. Alien enemy is the country with which we have a war with. Then there is the third point, why mode in modes of dissolution, that is happening of contingency. Happening of contingency is happening of any event. Okay, this is like on expiry of a period of a fixed term, like a fixed contract or something like that, completion of a venture. So when the partnership firm is created for single activity for a with a purpose to do only one single activity, and that activity is done, then death of a partner. Imagine there were two partners and there is one of them has died. So the partnership firm cannot continue. So there will be dissolution and insolvency of partners. So these are the events that can happen because of which the dissolution will happen. Then the fourth mode of dissolution is by notice. So when the partnership is at will, hope you know what does it mean by partnership at will. When partnership is created at will, written notice by any partner. Okay. Then coming to the last point, I think. Yeah, the last point is by court's order. Okay. The court may court, you know what is a court, right? Court may dissolve the firm if partner becomes insane. Partners become insane. Insane is lunatic, right? They have some psychological issue. There is a permanent incapacity to carry on the business by partners. There is a misconduct which is against the laws. There is a continuous breach. So, like, if the partnership partners have done something wrong and the court has said, please don't do it again, but partners keep repeating that thing, then that is called a continuous breach. Continuous breach, the word breach means not following something, right? And then there is the business is running at loss. So, unnecessarily, the partners are running the partnership firm, whereas the business is incurring only losses. And apart from this, what just an equitable grounds. That means whatever the other reasons that the court may think is reasonable, on those reasons, on those because of those reasons also the court may order a dissolution of partnership. Okay. Now, settlement of accounts. This is really, really important. This is important with perspective of theory and practical as well. So there are two things. One is you have theory and practical both in settlement of accounts. So this is important for theory plus practical. Okay. Huh. Here, first one is the treatment of losses. First point. Under this, the losses are paid out of profits, then out of capital. So that means the accumulated profits, the losses, whatever are being incurred, will be first paid out of the accumulated profits, then out of the capital contribution of the partners, and then lastly, say still the debts and losses are still remaining, then lastly they are paid by partners individual personal assets in PSR, profit sharing ratio. Then application of assets. Assets are used to pay first. So you have to remember this order. The assets will be paid. Assets will be used to pay the liabilities in this specific order. This is the order specified by the law. You cannot change it. So you have to remember that the or like whatever is the order given, that I am writing it down. This is the golden order. Remember it. Fix it in your brain. Fix it in your mind. Get it in your DNA. Don't forget it. Okay, the first one is outside outside liabilities. Okay, the second is partners loan. Then if any surplus is there, then it will be given in PSR to all the partners. And now here another point comes up which is really important is the differentiation between firm debts and private debts. What is this? So the firm debts are firm's property. How do you pay them? Firm's debts are paid with firm's property, and private debts are paid with private property. What is private property? Private property is your partner's private property, right? Huh. And private assets of wife and children are not included. Remember this. Only private property of the, you have to write it down here, of wife or children are not included. So the while paying the debts of the firm, only the private assets of the partners are considered. Wife and children, just because they are wife and children of the partner who is insolvent, doesn't mean they have to pay, their private property can be used. Okay, good. Then the next one is the accounting treatment. What goes on which side and what goes into the realization account. So first thing is you have to prepare, very important thing is you have to prepare realization account. Why realization account? Why? Why, ma'am? Why we have to prepare realization account? Why? So, this is to find profit or loss on dissolution. What is happening? Is it a profit or a loss to close down this? So, now, very important. I think you draw this separately in the next page so that it will be easier for us. I mean, the easier to revise also. Make a table kind of a thing. Okay, make a table, realization account, a table, debit side and credit side. Remember this list, nothing will come out of this list. First one, all assets will come this side except cash and bank. Then all payment of liabilities. Payment, remember, payment of liabilities will come this side. Okay. Then realization expenses will come here. Then loss. So we'll just write it till here for now. And then all external liabilities will come here. External liabilities. Please remember, capital accounts will not come here. External liabilities will come here. Then proceeds received. Proceeds from sale of assets will come here. Okay. Then assets taken over by partners will come here. By partner will come here. And then the last one, if loss has happened, loss transferred to capital accounts will go to the debit side, and profit transferred shall go to capital account shall go to the credit side. Remember, this is the transfer entry. Your loss will come here and it will be transferred this side, and your profit will come here and it will be transferred. So the balancing figure of profit comes on the debit side, and then when you transfer it, it comes on the credit side. And your balancing figure of loss comes on the credit side, but when you transfer it, it comes on the debit side. Okay? And always remember, when you are transferring the assets, then debtors, I can close it here, debtors will come at the gross value. So not at the net value. You don't have to deduct the provision for doubtful debts. And the provision for doubtful debts will go with the liabilities. Okay. Now there are some important journal entries that we have to remember here. We'll make a table out of it. So again, situation, debit, what will be debited and what will be credited. Okay. First, assets transfer. In this case, realization account is debit and asset account will be credit. Then there is liabilities transfer. You will have liabilities debit and realization credit. Assets sold. Bank debit, realization credit. Then assets taken over by partners. Partner capital debit, realization credit. Then liabilities paid. realization, debit, bank credit. Then liabilities taken by partner. What will happen? Tell me. It will be realization, debit, and partner's capital credit. Okay. Unrecorded asset realized. So it's not recorded, but it is realized. So bank will be debit and realization will be credit. Unrecorded liability paid. Realization debit and bank credit. Okay. Profit on realization. Realization debit. Partners. We'll just write capital account here. That will be enough. Capital account credit. Loss on realization shall be capital debit, realization credit. Okay. I hope you have written down this table along with me. Then what will we do with the second point over here, this is A, and the B point is partners capital account. Okay. In this, what we'll do is we'll start with the balance brought down. Start with balance brought down. Add share of reserves and share of profit from realization and subtract share of loss share share of loss on realization and also assets taken over of realization and assets taken over. Okay. Okay. And the final balance is paid through bank. So this is the last step in realization, that is C step, bank or cash account. So in bank or cash account, what we do? Opening balance will be there. Then we'll add the sale of assets or partner's contribution and we'll subtract the payment to liabilities, abilities and capital balances. And with this, your bank balance shall become 0. So if your bank balance has become 0 at the end, then that means you have done it very correctly. And this is the last part of this chapter. Very simple, very easy. It's just logics, don't worry. It's just logics, okay? Don't panic, it's just logical. First one is insolvent, insolvency partner, insolvent partner. What happened? The partner has become insolvent, nothing more. Insolvent partner. That means there is a deficiency that is equal to the deficiency is equal to the capital loss. Okay? And it is borne by solvent partners, all the other partners. Okay? So when there is deficiency in capital account, that means there is so when there is deficiency in capital account, that means the partner is insolvent and it is borne by the solvent partners. Now the second thing is unrecorded assets. So we have covered this earlier as well. So unrecorded assets or liabilities are directly through the realization account. So when there is an unrecorded asset, that is credit to realization account. You can go through the earlier table that we have written, and when there is a liability, it will be a debit to realization account. Okay? Okay. Simple. This is there in the earlier table as well. You can refer that to know the counter effect of the entry. Then what about the realization expenses? It is paid by the firm. When it is paid by the firm, then it will go to debit side of realization account. When it is paid by the partner, it will go to debit of partner's capital. And when the partner agrees to bear it personally, like he doesn't say that it will be on the firm, it says he'll do it personally, then no entry shall be made. If he pays from his personal account and it's not from the business. And the last one, a bit more, a last push, that is assets taken over by partner. This is quite simple. Debit the partner capital and credit realization. This all we have done earlier while we were discussing the table. Still I have given you once again the specific situations. So this is the chart that we have made, and your realization accounting treatment is on the separate page with separate tables. Okay, we are finally done with this chapter as well. So guys, we are going good. This is the fourth revision video that has been uploaded. We'll upload the remaining videos as well for company accounts. That is your next textbook. That is your textbook too. Till then, till we meet in the next super revision session, stay safe, stay healthy, eat healthy, drink lots of water, and keep revising smartly. Bye bye.